Good morning. Welcome to Stock Market Today. It's Friday, May 1st, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today, where you can sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider with further analysis. Hit your inbox every trading day before the market opens. So U.S. equities were lower in Thursday's trading as initial jobless claims came in worse than expected and offset well-received earnings reports. Treasuries were mixed with the curve steepening. The dollar was stronger on the yen cross, but weaker against the euro and the pound. Gold ended down 1.1%, reversing early strength. WTI crude settled up 25% after jumping 22% in the previous session. As we get to the desk this morning, futures are under pressure after Amazon and Apple reported earnings last night. Down about 2% here in pre-market trading. Australia and Japan were lower overnight, while the rest of, or most of Asia was closed for a holiday. The May Day holiday closes a lot of the markets in Europe as well. Treasuries were stronger with the curve flattening. The dollar is weaker against the yen and the euro. Gold down 80 basis points. WTI crude off a little over 1% after that big two-day rally. So for the S&P 500, we are holding above the zone after the fade from that 61.8% retracement level and still below the 200-day moving average, which sits at about 30.05. Initial support, 2750 to 2800. Below that, 2485 to 2660 are now the key retracement levels after the market made a high on Wednesday in this move, Have to recalibrate the key retracement levels, and that's what we've done here today. Resistance is in the 2950 to 3005 zone up there, the 200-day moving average. We are overbought in the near term based on the 13-period CCI, but Chaikin money flow is bullish. So indicators are mixed. The way I see it is, if I'm going to try to frame up risk reward here, we're close to resistance and further from support. I mean, there's no other way to say it. Does that mean we can't break out? Of course we can. But if you're just kind of playing probabilistically, there's more downside than upside from current levels. I think the upside case is a little bit harder to make here, especially if the big leaders are going to trade lower following earnings, right? So we have Amazon trading down today. We have Apple trading down today. Tesla gave up big gains yesterday to close down on the day and is trading lower in the pre-market. So I think the upside case is just a little bit tougher to make. It was an easier call down around 2650. Market in a minute now. What are we writing about? Well, we touched on the fact that stocks fade as those initial claims offset well-received earnings reports. Small caps are led to the downside yesterday, and we're going to take a look at the small cap chart here a little bit later on in the show, at least on a relative basis. The key retracement level acts as resistance as sell in May begins, right? So we have to take a look now. The old adage of sell in May and go away. Kind of be interesting that the market rallied to key retracement levels right in front of that date. I'm not putting a lot of weight behind it. It's just anecdotally an interesting point. If I want to stay bullish here or I want to get bullish here from here, I want to see high beta continue to improve. So far, that is not the case. Futures point to a higher open here today. I'm sorry, they point to a lower open here today. Got a little bit of a typo in my note. Taking a look now at what's happening from an industry perspective or the major indices on a power bar basis, 3 to 12. Bulls to bears for the Dow, which was down 1.2% yesterday. S&P 500 down 88 basis points, 49 to 164. Bulls to bears there. NASDAQ was an outperformer yesterday, as some earnings reports were well received, but again didn't manage to close lower. A little bit to even on the power bar ratio there. And small caps, after couple days of big rallies, led to the downside yesterday, and that I think is important because if you want to consider further upside, I think you need to see small caps continue to outperform. Bonds downtick, sending yields higher. According to the Chaikin Power Bar, large cap stocks are more bearish than small cap stocks. Major indexes are mixed. Taking a look at our stock of the day now, it's Darden Restaurants, DRI. I'm highlighting it in my note today because I think it's an interesting setup here. I think if you played the rally in restaurants, you want to think about taking some off the table. If you're potentially looking to play for some downside, I like the setup here. Darden has a bearish rating at Chaikin Analytics. It's a weak trend in a weak industry group, right? Hotels, restaurants, leisure, obviously one of the weaker areas of the market, especially from a power bar perspective. The stock rallied to the declining long-term trend line. You're going to see a lot of charts that look like this at Chaikin Analytics. Rallies to the long-term trend line and beginning to fade. Right? Chaikin money flow is bearish. We are rounding lower in an overbought condition based on our indicator. And while improving of late, we are still a laggard, or Darden is still a laggard relative to the broader market. So, you know, if you were a mean reversion trader and you were looking for the beat up areas in the market, you've had a nice trade in some of these restaurants, might be an opportunity to take some off the table. Take a look at Darden as a potential idea here today. Looking at our sector tracker now, the movement of the major sectors over the last 5 days. Energy, fins, materials at the top of the list. Discretionary doing well with Amazon. But the report last night has Amazon trading lower in the pre-market. So we're going to want to take a look at a discretionary and how it trades today. Tech, industrials, comms, middle of the road, REITs, healthcare, staples, and use. So your defensive groups have been lagging into the most recent leg of this March higher. So what's interesting now is as we're at key resistance levels, as we're nearing a declining 200-day moving average, do you see a rotation back in the other direction, right? If the market starts to fade and you see these defensive areas in the market begin to outperform, there's information there. If you're playing for the reflation trade, you're going to want to continue to see groups like energy, materials, outperform. So a little bit of a roadmap, a little bit of a thought process. Our industry in focus today, cap market services, has been a laggard over the past 6 months, trailing the S&P 500 by 3.25%. But it does have a neutral power bar ratio, 8 bulls to 8 bears there. It gets at a rank of number 7 of 21 subsectors, having moved up 7 slots over the past week. So of those 8 names that are bearish, you want to avoid names like Blackstone, BX, CME Group, CME, and FactSet Data Research, FactSet Research Systems, FDS. All of those stocks have very bearish Chaikin power gauge ratings within our 20-factor model. And again, I told you you're going to see a lot of charts that look like this, and you do, right? Rally back to the declining long-term trend line and beginning to fade, right? Neutral rating, neutral power bar, weak trend below that declining trend line. Now, get a little bit of a mixed situation here, quite frankly. With this group. Strong bullish money flow, overbought, oversold indicator moving higher, but in the middle of the range, but the group continues to be a laggard. It's improved of late, but still a laggard. So it's a solid neutral, right? At the end of the day, to me, this looks like a solid neutral. I think if you're going to go fishing for names there, you got to really be selective, focus on those 8 bearish or very bearish stocks. And I think at this stage of the game in the market in general, being a little bit more selective makes a ton of sense. So confluence of resistance for the market, confluence of resistance for a lot of the ETFs that we're tracking. Taking a look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers. On the gainer side of the board, a lot of this is going to be earnings driven. Quite frankly, we're in the heart of earnings season, so we're going to see a lot of movement in and around earnings. Abiomed up nearly 13% following their print. ServiceNow, one of the SaaS companies, up 9% yesterday following their earnings report. Nielsen has a bearish rating here at Chaikin Analytics, but the stock did rally 5.5% on their print. Facebook, one of the key fan mag names, up 5.4% yesterday following their earnings report. Stock does have a bullish rating here in our model. Cabot Oil and Gas, some speculation out there that COG could be a beneficiary as lower oil prices could be a positive indicator for the price of natural gas. And one of the best ways that investors seem to think to play that is through Cabot, which was up 4% yesterday. Loser side of the board, TPR, their earnings announcement, down 12%. TXT, down 12% on earnings. TAP, Molson Coors, down 11% on earnings. Harley-Davidson had a big move higher following their earnings report, gave some back yesterday, still a very bearish stock here. And Gap, nothing company specific there. A lot of the retail names were under pressure yesterday. I did see a report late in the day yesterday as I was doing some reading that J. Crew was potentially preparing to file for bankruptcy. So I think similar to what you've seen in the oil patch, I think it's likely that you're going to see some bankruptcies in the retail space as well, right? Highly levered companies into the teeth of a slowdown. So the retail group came under pressure yesterday, and I did see that report, or it was an article that J. Crew was preparing to file. All right, so let's take a look at some of the key themes that I look at every day, publish on them every week. A lot of these tend to do with what is the risk appetite in the market. So one of the best ways that I think to see that is looking at high yield relative to treasuries, right? High yield, obviously risky bonds. Treasuries, relatively safe assets. Fed, in theory, could be buying both. That was the big spike you saw in high yield, but we've subsequently given back that spike, right? So high yield still an underperformer relative to treasuries, right? A little bit of a snapback rally after high risk stuff really got oversold, and we've snapped back here, but we are still below the declining 200-day moving average. What's interesting to me is that the rally has not been able to get the ratio to exit bearish ranges for the RSI. So we're still in a bearish momentum regime for this relationship. And it's something I think that if you want to get excited about the market, you're going to want to see high yield outperforming treasuries as a sign of risk-seeking activity in the marketplace. A little bit of a bounce off the lows, but still a lot of work to do as far as I'm concerned. What does that mean across broader asset classes? Well, as high yield has rallied relative to treasuries, the 10-year yield has kind of stopped going down, right? I do still think that there's further downside in treasuries, the yields, but I'd be watching this relationship closely for signs that that view remains valid, or if we should come off that view. And obviously the movement in treasuries has implications in the equity market. So that's how we bring it all together. Taking a look also too at a risk metric, high beta versus low volatility, right? If investors are feeling good about risk, stands to reason they would skew towards the higher beta names at the expense of low volatility. And what's interesting to me is that despite this bounce, we're still below the 200-day moving average. Now we've broken support. So that is a step in the right direction. Now contrast this though, right? Here, RSI actually managed to break out of bearish ranges, right? So what you'd want to see here now is stabilization above this breakout level, retake of the 200-day moving average while this RSI holds bullish ranges. That to me would be a sign of a trend change. We started to see it towards the tail end of last year, but that quickly dissipated, right? Remember the fourth quarter rally in the market breaking out in October, and that quickly rolled over as the new year began, and then look what happened to the market in general. At the same time, we want to be paying attention to utilities on a relative basis, right? Because that's another risk on, risk off type metric. Now, utilities relative to the S&P 500 are holding above support for now. I think that if you start to see utilities outperform while high beta begins to underperform, that would give you an indication of what's going on, bigger picture within the marketplace. So taking a look at these risk themes, these intermarket relationships, drilling down and away from the broader averages can give you a cleaner picture of what's happening in the marketplace. Finally, we'll wrap it up with small caps, because to me, that's another risk theme. And it's interesting. Again, it has my attention, just like energy not going down with oil cratering caught my attention, and it's something I'll be paying close attention to. I want to be paying attention to this relationship. Small caps relative to the broader market, the S&P 500 rate. Small caps been lagging for some time, and we've been all over that theme. Now we had a bit of a stabilization down here, a bullish divergence, and then a breakout through the consolidation. You want to see small caps hold above this breakout level and continue to work higher, while RSI holds a bullish regime from a momentum standpoint. And obviously, you'd love to see them continue to work higher on an absolute basis if you want to get bullish on this market. These are the key metrics that I think you should be paying attention to get a gauge for the overall risk sentiment in the marketplace and start to lay out the roadmap on where we could go from here. So I think there's still a lot of work to be done. I think at current levels, the upside case is a little bit harder to make, but these are some of the relationships that you would expect to see moving in one direction or the other to give you a sense of the likely path of the broader market going further, especially as it relates to risk-taking activity in the marketplace. That'll wrap us up for today. Head over to chaikinanalytics.com/test drive. Sign up for a free 14-day trial. I hope that everybody stays well. I hope that everybody has a great weekend. I'll be back with you on Monday.